Gold just lost $60, and the Federal Reserve is now betting on a rate hike by October. That means you're a safe place to store wealth might not be so safe if oil spikes again. Markets closed Friday, June 19, 2026. Here is where everything ended the week. Like and subscribe for daily market updates. Today's agenda: the weekend mood, market snapshot, Fed policy shift, geopolitics and oil, precious metals action, crypto market moves, SpaceX and AI deal. Let's look at where those major indices actually closed out last week. It's Saturday morning and Wall Street just finished a wild ride. We had two massive earthquakes this cycle. First, the Fed shifted from wanting to cut rates in late 2026 to actually raising them by October, because inflation won't quit at 4.2%. Second, SpaceX bought an AI startup for $60 billion, briefly becoming one of the most valuable companies on Earth, while regulators watch closely. On paper, stocks rallied last week as oil prices fell and peace talks seemed real. But look closer. That was a relief bounce off fear. The market is risk-seeking right now because it thinks the worst global political stress has passed. However, if those peace talks in Switzerland fall apart completely, we could see panic selling again very quickly. Up next, Federal Reserve policy shift. Thursday gave us the final full picture before Juneteenth. The S&P 500 rose 1.08% to $7,500, while the Nasdaq jumped almost 2% thanks to chip stocks reversing hard higher. Small caps led everything up by over 2% as Treasury yields ticked lower for a moment. But here's what matters. Gold slid down to roughly $4,165 an ounce, and silver fell nearly 5% because the dollar index climbed to a one-year high near 100.5. Oil steadied around $77 after falling 10% on the week, erasing most of that war premium. This inflation spike is directly tied to global politics and the Middle East conflict. On Wednesday, the Federal Reserve held interest rates steady within the 3.5% to 3.75% band for a fourth consecutive meeting. However, this pause was merely tactical rather than the strategic rate change investors anticipated. The true market-moving event occurred during the accompanying dot plot release, signaling a dramatic internal shift. 9 of 18 policymakers now project at least one rate hike by year-end, explicitly abandoning earlier consensus that suggested imminent cuts. This reversal stems directly from persistent inflationary pressures. May's Consumer Price Index surged to an annualized 4.2%, heavily fueled by volatile energy shocks and sticky service costs. Consequently, the Fed upgraded its own personal consumption expenditures inflation forecasts significantly higher than previously modeled. Historically, such a sudden rate change in policy expectations triggers immediate unpredictable price swings as markets reprice risk premiums across fixed income sectors. The mechanism is clear. When central bank officials publicly acknowledge that price stability remains elusive despite prior raising interest rate cycles, bond yields typically spike to reflect the new reality of prolonged high rates or even further hikes before stabilization returns. For investors holding long-duration bonds, this implies potential mark-to-market losses as yield curves steepen unexpectedly. Equity sectors with heavy debt loads face compressed valuation price-to-earnings ratios due to rising borrowing costs extending well into 2025. The second-order effect is a recalibration of earnings models that previously assumed an easier available cash in the market environment was imminent. Capital allocation strategies must now account for the possibility that inflation resilience in the energy sector will force policymakers to prioritize price stability over growth support, fundamentally altering the investment landscape from one expecting relief to one bracing for sustained pressure on asset prices and cash flows alike. With peace shaky again, let's see how precious metals reacted to this dollar strength. The dramatic, unpredictable price swings witnessed in energy markets this week traces directly to escalating tensions with Iran, a global political flashpoint that has repeatedly threatened global available cash in the market. The conflict initiated last February effectively strangled the Strait of Hormuz for more than 3 months, creating an artificial scarcity that pushed crude prices toward triple digits before recent diplomatic efforts secured an interim peace framework. This stabilization is not merely symbolic. It represents a tangible relief valve for supply chains worldwide. Crucially, nearly 10 million barrels were observed transiting near the strait again this week, with Saudi tankers moving freely through the choke point on Thursday without incident. Such normalization is economically vital, because any renewed disruption in that narrow waterway instantly reignites inflation fears across global manufacturing and logistics networks. Historically, we saw similar spikes during the 1973 oil embargo or the Gulf War of 1990, where regional instability caused immediate, lasting price shocks regardless of actual production cuts. Investors must now recalibrate their risk models. While headline prices may have stabilized due to diplomatic progress, the underlying unpredictable price swings premium remains embedded in futures contracts until security is guaranteed long-term. For portfolio managers and commodity traders, this shift implies a lower near-term probability of supply-side panic, but necessitates monitoring secondary effects such as insurance costs for maritime shipping and potential retaliatory cyber attacks on infrastructure. The market has already expected by the market piece, yet the memory of past disruptions ensures that even minor skirmishes could trigger rapid sell-offs, making global political intelligence just as critical as fundamental demand data for navigating this fragile recovery phase. Crypto felt that same gravity from high rates, even though some whales are buying the dip secretly. Precious metals diverged sharply from stocks this week, as a surging US dollar index acted as a mechanical headwind for non-yielding assets. When the greenback strengthens, it effectively raises the price of gold and silver in foreign currency terms, dampening demand from international buyers who must sell more of their own currency to purchase these commodities. Consequently, gold finished lower on the week after failing to find support near recent highs, while silver suffered a steeper correction. The industrial metal tumbled approximately 4% to close around $64 an ounce, marking its lowest trading level since early June. This decline reflects second-order effects, where investors rotate capital out of defensive hedges into higher-yielding bonds or tech stocks, when real interest rates remain elevated due to the strong dollar environment. Historically, silver has often experienced greater unpredictable price swings than gold during periods of raising interest rates available cash in the market, because it serves both as a monetary store of value and an industrial input. However, this week's drop was primarily driven by big-picture economic flows rather than supply constraints. For investors holding these positions, the immediate implication is that short-term rallies may be capped until the Federal Reserve signals further rate cuts or global political tensions reignite a safe place to store wealth demand. Until then, precious metals face a headwind, where every basis point of dollar strength translates directly into price weakness for bullion portfolios seeking portfolio diversification against equity unpredictable price swings. SpaceX was the loudest corporate story this week, with a massive IPO and an even bigger acquisition deal. Bitcoin tumbled below $62,500, shedding over 2% in value by Friday's close as profit-taking accelerated across major digital assets. Ethereum mirrored this downturn initially, but revealed a distinct divergence. Large institutional holders, known colloquially as whales, deployed nearly $1 billion into Ethereum during the sell-off, while capital simultaneously rotated out of Bitcoin spot ETFs toward their counterparts linked to Ether. This mechanical shift suggests investors are increasingly viewing altcoins not merely as correlated tech plays, but as undervalued alternatives within a broader portfolio, rebalancing act against regulatory challenges facing pure-play Bitcoin exposure. Historically, such intrasector rotation often signals that the crypto market is maturing beyond its early days of monolithic dominance by Bitcoin alone. Similar patterns emerged in 2017 when capital flooded altcoins as initial interest waned on the leading asset. The immediate implication for traders is a need to scrutinize order flow more closely, distinguishing between panic selling and strategic reallocation. For long-term holders, this dynamic indicates that, while big-picture economic pressures may weigh heavily on Bitcoin's price action in the short term, Ethereum could offer a relative value opportunity if institutional demand persists despite broader market unpredictable price swings. Finally, let's wrap up with what investors should watch over the next 72 hours before Monday opens again. The narrative surrounding SpaceX's market entry has shifted dramatically from a standard initial public offering into an unprecedented strategic maneuver, effectively becoming the largest capitalization event in recent history by leveraging its soaring equity as direct currency for acquisition. By agreeing to purchase Cursor Technologies for $60 billion entirely through stock issuance rather than cash reserves, Elon Musk and his team have have signaled an aggressive intent to dominate the artificial intelligence infrastructure landscape. The stated logic hinges on a critical need. SpaceX requires strong developer platforms that can seamlessly feed high-volume data into their proprietary Grok models, thereby creating a self-sustaining feedback loop between orbital hardware and software intelligence. This move directly challenges entrenched giants like OpenAI by attempting to bypass traditional licensing fees and build an integrated ecosystem where rocket telemetry and satellite imagery become primary training datasets for next-generation large language models. Historically, few companies have utilized their own equity as the sole payment vehicle in such a massive transaction without immediate cash flow concerns. This suggests confidence that future earnings will justify the valuation gap between current stock prices and acquisition costs. For investors, the implication is clear. Capital allocation strategies must now account for vertical integration across aerospace and software sectors, while recognizing that access to SpaceX's data pipeline could become the new moat against competitors relying solely on public internet scrapes or limited enterprise partnerships. Markets closed Friday with a relief bounce, yet the underlying economic regime has shifted dramatically. The Federal Reserve now projects interest rate hikes by October rather than cuts, as inflation remains stubbornly high at 4.2% due to energy shocks from global geopolitical tensions. Consequently, gold and cryptocurrency prices fell sharply, while the dollar surged to new highs. Although oil prices stabilized near $77 following brief peace talks in Switzerland that ultimately collapsed, investors must now closely monitor tanker traffic through the Strait of Hormuz. Any disruption there could instantly spike inflation further. Thanks for watching Market Pulse Daily.